Thanks for everyone. First of all, good afternoon. Myself, I'm Suresh. Today, we have an update from Mr. Bhavesh Kanani on the financial opportunity portfolio. This is the regular which we are doing a quarterly update on the portfolio. Before starting the session, I would like to give a brief on Bhavesh Kanani. So Bhavesh have a very rich experience about 2 decades in equity research, at the same time as a fund management, and globally as well as the domestic. So he has been handling both the sides, which have a good experience on both the markets. If you before joining with ASK, the Bhavesh has worked with the reputed organizations like Sharekhan, Centrum, Citigroup. Most of the reputed firms has been in the research firm. So he's been there with the ASK almost a decade to take care about the BFS segment and in detail on the research point of view. So the next about 10 to 15 minutes, Mr. Bhavesh will touch upon the FOP portfolio, what actually happened in the last quarter, what are the changes we have done in the portfolio. Post that, we will have a Q&A with him. So I request all the participants to type the questions and Q&A. So we will be consolidate those questions and we'll take it from the answers from the Mr. Bhavesh. So thanks Bhavesh Bhai for joining here, and over to you.
Thank you, Suresh, for those kind words. Let's get down to the business. So to begin with, let us talk about credit growth. The blue line, which represents the average credit growth for the system, was pretty healthy. Naturally, private sector banks' credit growth was higher than that of PSU banks. Within the credit growth, if we look at sub-segments, we can clearly see that the manufacturing sector credit growth has been a little slow, whereas services, agri and retail are the segments that are driving the growth. This 28.5% retail segment growth includes the impact of HDFC Limited merger into HDFC Bank. Large corporate credit growth still remains pretty meek at around 7% odd. And if you look at entity level, we can find that in most cases, the growth in deposits is lower than that of loan growth, except for ICICI Bank and Kotak Bank. The reason behind this is the liquidity situation remains pretty tight, and RBI is not willing to relax its withdrawal of accommodation mode. And as a result, while the yield on advances have become more or less flattish, the cost of fund continues to rise, thus creating pressure on net interest margin. As a result, we saw net interest margin coming down further in Q3. However, the pace of contraction during Q3 was lower than what we saw in the previous quarter. On asset quality front, it is a reasonably good picture with GNPA continuing to improve for the industry, whether it is private sector banks or PSU banks. But when we look at credit cost, that is provisioning levels, while it came down for PSU banks, it actually went up for private sector banks. And this is largely because of the AIF related provisions required by RBI. And this impact was maximum for some of the leading private sector banks like HDFC Bank, Kotak, and Axis. On treasury front, during the quarter, we saw that short-term GSEC yields were largely flattish, while long-term yields moved in a narrow range with a downward bias. And as a result, we had a reasonable kind of treasury gains. At aggregate level, we had 54 billion kind of treasury gains, which was higher than 44 billion we saw in the previous quarter, but flattish compared to 52 billion we saw in the year ago quarter. At core operating performance level, there was a reasonable growth for private sector banks. However, for PSU banks, the core operating profit was lower than what it was a year ago. During the Q3, we saw NIM pressure, which we just talked about, and the other factor impacting PSU banks' operating performance was the wage provisions. Most of the PSU banks have seen, the negotiation of pay hike for government employees has been finalized at 17%, and most of the PSU banks were providing anywhere between 12 to 13%. And this higher pay hike led to higher provisions to clear out past arrears as well. And as a result, we saw core operating performance witnessing some pressure. Because of all these reasons, the ROA for private as well as PSU banks continues to see marginal erosion. It was a little sharper for PSU banks because of the wage hike related challenges. But nevertheless, the direction is downwards for ROA. On NBFC's front, it's a mixed bag. So we'll take the various business segments separately. For auto financiers, the AUM or loan growth remains pretty healthy. However, incremental disbursement numbers are indicating that there is some bit of moderation. Now, this moderation could be because of ensuing election, because typically just before election, demand and investment of this kind tends to take a pause. And once the election results are out, the demand for CVs tends to come back. So at this stage, we are assuming that this is going to be an election-oriented moderation, and in the second half of next fiscal, we should see demand coming back. In contrast to banks' experience on NIM, for auto financiers, the NIM was stable to expanding, depend on which player you talk about, as the increase in cost of fund has more or less stabilized. And auto finance tends to be a fixed rate business, so repricing of loan is gradually translating into gradual improvement in yield on advances. On microfinance businesses, we saw that there was some asset quality pressure, largely because of floods in Tamil Nadu and collection-related challenges in Punjab. NIM here too was stable to expanding as yields continues to move up due to repricing benefit. On affordable housing finance front, there were mixed trends on NIMs depending on which player we are talking about. Players with fixed rate loan books saw flattish NIM like Aptus, whereas players like HFFC, that is Home First Finance, and Awas, who have a larger floating rate book, saw NIM contracting. On GNPA front too, we saw flattish trend for Home First and Aptus, while the same deteriorated a little for Awas. In general, diversified lenders did acknowledge that there is some bit of stress in small ticket personal loans, and as a result, there is need to calibrate growth on unsecured personal loan front, especially the small ticket size. On life insurance front, growth has been a little slower since the time we saw the tax rules changing in the last budget. Because of the new tax rules on non-par savings, the focus of insurance companies has shifted to ULIP. ULIP is a low margin business for insurance companies, and as a result, different companies have taken different stance. While HDFC Life has chosen to protect its margin and let go of growth, on the other hand, we have seen players who wanted to maintain higher growth, but they have seen margin contraction. So it's a different choice or strategy adopted by various companies, which is visible in the Q4 results, Q3 results. At aggregate level, the portfolio generated a 25% kind of growth at sales level, and at operating profit level, the growth was a shade lower at 19%, and the similar kind of growth at bottom line level. These are the performance numbers. In terms of macro outlook, more or less, large part of the trends that we discussed in last quarter continues, with capex-led volume growth sustaining in this quarter as well. However, domestic consumption continues to face challenges, along with export too remaining a little weak. Consumer discretionary volumes remain muted after the festive season, largely because of the patchy monsoon, which led to lower agri income and inflation, especially food inflation, was sustaining high. Incrementally, we need to focus a lot on Rabi season and its sowing because this will have significant implication for rural cash flows. Specific areas having direct bearing on banking sector. Private capex demand is yet to trickle down to banking sector in form of loans. We expect that a lot of sanctions that have happened for project financing should translate into better loan growth for whatever is remaining in this fiscal 24 as well as for the next year. As we discussed, patchy monsoon impacted the agri incomes adversely, and the implication of that can be seen on consumer staple as well as consumer discretionary items. This is direct implication for microfinance companies, vehicle finance companies, and affordable housing finance companies as well. Food inflation continues to sustain at higher level despite the fact that overall CPI has eased a little. Moreover, liquidity remains tight as RBI in its judgment recently said that they want to continue to withdraw accommodation. And because of tight liquidity situation, we have seen money market rates continue to remain above repo rate. And as an implication of this, the expectation of policy rate cuts has been pushed further to second half of FY25. Overall, RBI's estimate suggests that healthy economic activity is likely to continue. For FY24, GDP growth has been pegged at 7.3 and about 7% for the following fiscal. With that, I end my part of the discourse. We can open the floor for questions.
Thanks, Bhavesh, for the update on the quarterly in the portfolio as well as the given the glance on outlook. I request all the participants to keep on typing the questions on the chat box or the Q&A. So we will be taking all the questions to be Bhavesh. Bhavesh, couple of common questions which has come from the before starting that also some of the people have been tested as doing also. Now, one, I think we have been seeing on the newspapers, there is a lot of guidelines from RBI on the e-loans as well as the Insta loans, which has put in the strict norms on that segment itself. So what is your view on that? How these news or the strict guidelines is going to affect the portfolio? Are we acting on that if it is any negative action on the portfolio?
Okay. So the RBI's actions are clearly aimed at ensuring that the customer is protected. RBI continues to receive feedback from people in general who are, facing issues with their loans, and they feel that they have, been misled on the key terms of the loans. As a result, RBI has been, instructing lenders that they should be revealing all the terms and conditions in a very short and concise form known as KFS, which is key fact statement. This kind of action was also taken for Bajaj Finance for their e-commerce loans as well as EMI card, and they have made the necessary changes. For a while, the new acquisition was suspended. So the implication for individual companies will depend on the extent of lapse RBI finds in their compliances and the kind of action RBI decides to take. If the concerns of RBIs and requirements are ensure that they are in place in form of key form statement and various detailed disclosures to customers, then probably the actions of RBI may not be as onerous. So it's a very case specific, evolution of the events. You're on mute, Suresh.
Thanks, Bhavesh, on the clarity point of view. Bhavesh, the second is a question which has come. I think recently we have completed about quarterly earnings.
Yeah.
Yeah. So how in terms of the management, the view on the overall NBFC and BFS segment, as well as the particularly on can you give a quick summary on our portfolio companies in the long term, the view on the next 2-3 quarters, how we can look it in as earnings commentary.
Sure. So as we have discussed in past, we are at a stage of interest rate cycle where incremental lending rate hikes are not happening because RBI has paused on the repo rate. As a result, the yields on advances or the interest rate charged by banks on loans is not going up. However, the cost of fund continues to inch up, and this has been causing margin pressures for banks as well as NBFCs to an extent. In this scenario, the NII growth, that is net interest income growth, has been lower than that of the loan growth. All the meanwhile, a lot of banks and lenders continue to invest in their branches and people, and because of which your OPEX spend continues to remain pretty healthy. Meanwhile, when we look at provisions, especially for, let's say, private sector banks, provisions have stabilized because GNPA improvement incrementally is not substantial. It is improving bit by bit, but incrementally, large part of improvement in GNPA is done with, and as a result, we should expect provision levels to remain stable for next couple of quarters. Essentially, we should be looking at PAT growth, which is more closer to your loan growth over next 2-3 quarters. That's the overall outlook.
Thanks, Bhavesh. Bhavesh, I think on the portfolio side, which you also mentioned about the performance, also you have been. So one of the existing customer is asking a question. Over the period of time, with the benchmark, the performance as the gap is rather than narrowing down, it is increasing. What was the reason for that, and what actions you are taking to bridge the gap and to create a more alpha?
So large part of the performance gap is largely because of FY22 and the challenges we faced then. If we look at year-to-date performance, our performance is pretty much neck and neck with the benchmark. And given our understanding or view that lending businesses will see incrementally, bottom line growth slowing, it has already slowed down from 30% plus to 16-17%, this quarter. Given this view that incrementally also we should see loan growth and bottom line growth mirroring each other, we are gradually shifting more and more weight towards non-lending financials where one doesn't have to face the interest rate cycle related pressures on profitability. As you would know, we in past have added MCX in this category and some other businesses where margin pressure was not present, like microfinance businesses. In months, we have added 2 more names, one of which is a fee-based income model, which is CDSL, and we have added Bank of Baroda to the portfolio. So our inclination remains to gradually increase the non-lending financial weight in the portfolio and thus protect the returns we have generated so far and try and bring better alpha to the fund.
Thanks, Bhavesh. Bhavesh, the last couple of months in the short-term point, where the 3 to 4 stocks, basically Bajaj Twins and HDFC as well as the AU, were the negative contributor to the portfolio. So are you, after the recent quarterly con call as well as the what action the portfolio are taking at the same time, are you going to trim the portfolios or going to add the portfolios in this section? So this would like to hear from a lot of customers are asking the same question.
Sure. So we have tried to cover a lot of this in the last monthly commentary, but since the question has come up, let me reiterate some of those facts. Uh, for each of the names you mentioned, the reason for negative stock reaction is different. When it comes to HDFC Bank, a large part of the reaction was because of the manner in which the management, shared its commentary and outlook. This, along with some of the financial parameters, one being the net interest margin, there was wide expectation that margins for HDFC Bank in the Q3 would improve to a great extent, as they were expected to run down excess liquidity on the balance sheet. While the rundown of liquidity has happened, the margin improvement also happened, but it did not happen to the extent people were expecting. Now, with excess liquidity now not visible on the balance sheet, incrementally for HDFC Bank to improve their margins, they need to increase the share of high-yielding loans such as unsecured personal loans, credit card, and so on and so forth. This is going to be a long, slow, and arduous journey for HDFC Bank. This changing of loan mix in favor of high loans is going to take 2-3 years before they are able to improve their margins meaningfully. So commentary around the net interest margin, the clarity offered by management and what actually happened during the result is something probably was not liked by the street. On AU Small Finance Bank, the results were marginally below what we were estimating, and largely the disappointment or concern from street was on account of their credit card portfolio, where it's a new business for AU Small Finance Bank, and whenever there is a new product on lending side, initially the GNPA levels tend to be very low because all the loans on the book are practically fresh and new. With time, as the loan book seasons, the GNPA levels tend to normalize. And for each product category, a normalized GNPA is different. For housing, it will be much lower compared to a credit card. Now, for Q3, AU Small Finance Bank's credit cost for the credit card business came at around 6.5%. If we compare in the listed universe, we have SBI cards. For SBI card, the same number was 7.5%. So AU Bank's 6.5% credit cost is not completely out of sync compared to what the industry is experiencing. It is a more normal number. But the fact that this normalization of credit costs happened in Q3 led to some pressure on bottom line. And as a result, we saw negative reaction on the name. For Bajaj Finance, well, here again, core performance was in line. But when we look at individual business levels, all the kinds of loans they are giving out, there was uptick in GNPA for most of the product segments. As I was highlighting earlier while sharing some of the exhibits, GNPAs were at their best levels in last couple of years because of the fact that demand was good, growth was happening, cash flows were healthy. But now we have reached a stage where improvement in GNPA at banking level has stopped. For some entities like Bajaj Finance, it is inching up marginally. Here again, there are a couple of seasonal factors at play, especially when it comes to rural segment where Bajaj Finance is operating there. There has been inch up in the slippages in personal loan segment. Similarly, in urban B2C customer loans as well, there has been uptick. However, this is to be believed to be temporary in nature, and it has got more to do with monsoon and related challenges in collection. With time, this should settle down, is the view as far as Bajaj Finance is concerned. So some of these trends, as I shared on the three names, the stories for the disappointment or knee-jerk reaction from street are different. For some, it is related to net interest margin. For some, it is related to credit cost and asset quality.
So, are we taking taking action on the portfolios? Like, are we waiting, or how do things? That is a follow-up question is coming. So, are you taking any
Sure.
action on this?
So the two names that we entered were, the weights were built on these new names after cutting down weights on HDFC Bank as well as Bajaj Finserv. What actions we may take in future is something that we need to leave to future.
Thank you, Bhavesh. Bhavesh, see, on the street, the PSU banks, which is something as whether you take it at 3 months or 6 months and the 1 year, which is the rocket performance is there, whether 30 or 40%. So the question is, the customers are asking, is it in a fair value in private index or in the PSU bank index? Where if the you would like to take some more exposure, already we have about 18-20% of the PSU is there. So you would like to add more in the PSU, or you would like to stick to the same exposure to the private as well as the PSUs? So where you are looking at the segment as the PSU segment?
So for PSU banks, we already owned State Bank of India, and more recently we have added Bank of Baroda to the name. In the benchmark, the weight of PSU banks is around 13%. And the combined weight of both these names in our portfolio is closer to that. So incrementally, it is all relative in that sense that if the opportunity in one of the PSU names on the banking side appears to be better, we may decide to exit some of the exposure, whether it is NBFC bank, and we may decide to build some more position on PSU banks.
Okay. So if you look at our portfolio, we have exposure to the life insurance companies, which is SBI and FF. Why can't we add the general insurance companies also in the portfolio to create a alpha, or we have any rationale for that not adding? So one of the customer is asking, we have a life, but we don't have any general insurance. So what was the reason for that?
Well, we used to own ICICI Lombard, and incrementally, as I shared, we are trying to move away from balance sheet businesses and into businesses which are not driven by balance sheet, which are mostly focused on fee income. As part of this preference, we decided not to further add insurance exposure. In fact, we have trimmed SBI Life some time back with this view in mind. While insurance business is not necessarily lending business, but it is a balance sheet driven business, and hence the call. And that is true for general insurance as well, in one sense.
Understood. Only in the portfolio of the stock called MCX. So we if people have bought a MCX in the exchange of business, but in the exchange business, BSE has done a very well in terms of their price performance and everything also. What was not the reason to buy a BSE than buying an MCX in the portfolio?
So see, in case of MCX, the reason for cheaper valuation for MCX was surrounding the tech transformation they were undertaking, and the challenges that they were facing related to moving to the new platform and its impact on the volumes. Second reason for preferring MCX was the fact that in context of the total derivative volumes on equity side, the volumes on commodity derivatives is extremely small, and hence a runway for growth for commodity derivatives over next 10, 20 years appeared to us to be much faster than that of equity. And that's the reason why we preferred MCX.
Understood. Understood. Recently, we added some of the few couple of stocks in the business like Fusion Micro and Great Access generally. Can you just throw about that industry into that? Why, as you also mentioned about the inflation also will have impact on this sector. So how will be having a more rational and what is the way forward these things?
So the reason behind entering credit access as well as Fusion was that for microfinance business earlier, there was a cap of 10% margin. So if your cost of fund is 10% for a microfinance companies, they can apply additional 10% margin and charge 20% rate from the borrowers. This policy or this guideline was withdrawn by RBI, and RBI gave freedom to microfinance lenders to charge whatever they feel was appropriate. In response, most of the microfinance companies hike their lending rates to microfinance borrowers, and as a result, we saw significant improvement in net interest margin for all the players. At the same time, the demand for microfinance loans was pretty solid, as well as the NPA situation was improving after reaching a peak around COVID times. So, because all the three factors were positive for the business, we decided to enter this segment through these two names. Incrementally, the demand continues to remain quite healthy. Last couple of years, especially during COVID, most of the microfinance companies have focused on collections rather than new client additions. Once COVID has settled down, all these microfinance companies have added more customers to their base without necessarily increasing the average ticket size. So both the players we have selected are quite disciplined on that regard, that they have not increased loan per head to report a higher growth. And given the reasonably healthy outlook for growth as well as NIMs, some asset quality challenges which are appearing to be temporary in nature related to floods in Tamil Nadu and some collection challenges in Fusion, the space of microfinance appears to be well placed.
Understood. Thanks for that. So one common, I think, as a investor is expecting that where I came for this portfolio as for the 5 years view, 5 to 6 years to view. So it's almost now 3 years is as completed my portfolio. I could able to generate about 9 to 10% as the expectation was about 15 to 16% from this portfolio. I have only the 1.5 year to 2 years view. I can expect about the target? Can I reach there, or should be there for the another more 1 or 2 years in this portfolio?
So what we have always maintained is that the earlier expectation of delivering a 15-16% compounded return was in light of the fact that that is the kind of earnings growth we were expecting from the stocks we had selected. Now, unfortunately, we have had quite a couple of seriously significant events which were adverse to the sector. If we take history right since the fund was launched, we have gone through ILFS crisis just after the fund was launched. Then we had challenges related to DHFL and Yes Bank, and eventually we have had 3 waves of COVID. Now, let us accept and understand that uh, the lending business, specifically within the FOP, is a high leverage business. So, when there are challenges in the economy because of whatever reason, the impact of that, adverse impact of that, is probably maximum or more serious in case of lending businesses. And as a result, the earnings growth too had suffered during COVID because of very high provisions, and which has impacted the returns we could generate. Incrementally from here on, assuming there is no untoward challenges of the order of COVID, we are trying to ensure that the portfolio earnings growth is of 15 to 17% growth, and the same kind of return gets reflected in price as well.
Bhavesh. Bhavesh, one last and thing which I have a question. As a customer, if I would like to add the money into the portfolio as a top up to create a alpha over the period of time, so can you give us 3 to 4 solid points to us to give the conviction or the point the customer? So if you want to add the top up in the money, so what are the 3 to 4 points where you give to us? Is yes, this is the right time to add the money into the FOP portfolio as in terms of the valuations or in terms of the prices. So what are the your points to for us?
See, as I said, this is a high leverage sector, so it needs a normal business conditions to perform. Incrementally, the path that India is riding on, and the expectations that the current government will continue to, remain in power even in the next term, gives me a lot of hope that India growth story will continue. And without help of banking sector, it is not possible to fund the growth that India is looking at, whether it is large project finance loans or funding the needs of individuals. Same is true for the savings story, whether we want to play it in form of insurance firms or in form of entities like CDSL or asset management firms. The saving story, in my view, has not even begun seriously because large part of Indian households continue to, focus on discretionary consumption at this stage because the disposable income has allowed them to consume more luxury goods. With time, the saving habits of these households who have just hit the threshold to consume more discretionary items, with increase in income further, they too will start to save meaningfully. Even today, when we look at a monthly SIP number, it is close to 18,000 crores, which itself signifies the kind of strength of inflows we are seeing from the saving households. So whether we look at lending business, whether we look at non-lending businesses of various kinds focused on saving story, the opportunities are immense. It is just that we need an operating environment which is conducive. Temporary factors such as interest rate cycles and all, they are nothing new. All the entities that we own have gone through multiple interest rate cycles. It's just that we should not be facing, unfortunate events like COVID, and if that happens, then if the runway is reasonably okay, smooth, operating conditions are okay, then this portfolio is set to deliver pretty decent returns. Considering that all the entities we have can deliver an earnings growth around 15 to 17% at portfolio level comfortably.
Thanks, Bhavesh. Bhavesh, I think as you mentioned, one more question has come on the mutual fund side. The AUMs are day by day increasing. It has touches the 50 lakh crores also. In that case, the AMC businesses and the wealth management businesses, the part of the portfolios, are you thinking, or how is that? Is the question which has come from the customer?
Sure. So naturally, the growth is quite impressive. And within the AUM growth, the share of equity in the AUM has only been improving. However, when we try to play asset management firms, there have been a couple of challenges there. While the growth has been good, you all know SEBI was considering significant changes in its TER policy. They had in fact released their draft guidelines as well, and after strong feedback from industry players, they put all those proposed guidelines on hold, and they promised that they'll consider the feedback from industry and come out with revised draft guidelines. That is yet to happen. This uncertainty also causes some bit of concern on the adverse impact of probable norms that may come anytime. Second aspect is valuation. So if one is comfortable on growth, profitability, and valuation, that is when we would like to enter the saving story through mutual funds. At this stage, we decided to play the saving story by getting into CDSL. At opportune time, we keep scanning the space naturally, and we'll take appropriate action at right time.
Thanks, Bhavesh. Here we were not able to see any further more questions. You would like to give any summary to the people, or else we can close the session and we will meet in the next quarter conference.
Well, that's all from my end. Wishing you all the best. You can always reach to us through Suresh or our sales team for any queries you might have and any support we can provide you.
Yeah. Thank you, participants, for joining on the call. As Bhavesh has mentioned, any questions which has been not unanswered, you can also send it to mail us to ce@askpms.in. We will be coming with the answers for that questions. Thanks and have a great day.
Good day, everyone.